What is up, guys? It's Finance Finn back again with another video. Today I wanted to talk about options trading because I've been getting a lot of questions about the subject and I wanted to make a quick video kind of explaining the basics. I might make it like a series about this, kind of going into more detail, but here's kind of like the big picture. What is options trading, right? So let's talk about it. An option is a contract, right? So you have two parties, a buyer and a seller. One person writes the contract and one person buys the contract off the person who's selling it or writing it, yeah? So a contract is the option or ability to buy 100 shares by a certain date at a certain price. And there's more fancy words for that. So an option, right, is 100 shares, or the ability to buy 100 shares at a strike price, right, which is the given price. So you think a stock is going to go from, let's pick Tesla, right? Let's say they're at $600. Let's buy Tesla options, thinking that they're going to go to $650, right? So you buy one option, which has, 100 shares. The option is to buy 100 shares of Tesla at $650, right? Currently, the share price is at $600. You want it to go to $650, right, for your option to come true, right? So right now, the option's out of the money, right? Because you're buying an option where you want the price to go up. This is called a call option. Currently, your option is out of the money, right? Because $650 is the strike price. You are currently under $650, which means you're out of the money. If Tesla increases in value, yeah, over the course of the week, and in the time before your expiration date of the option, surpasses 650 or even hits 650, your option is now what's called in the money, which means that you could theoretically exercise your option and make money on it. Right. So why does an option cost money when it's out of the money, right? Because it's not worth anything. That isn't quite true, because there's a thing called the time value of money. Or theta, which is actually something that you're working against when trading options. When you buy an option a year out, think about if you buy an option on Tesla, right, thinking it's going to hit $4,000. That's very unlikely, but it is way more likely than if you bought an option for a day out for $4,000. Like, Tesla is most likely not going to go to $4,000 tomorrow, right? That's common sense. Over the course of a year, it's unlikely, but it could potentially happen, right? Over the course of 5 years, it becomes even more likely. 10 years, it becomes even more likely. You can't buy options out that far in advance. I think it's only 3 years, but you get the point. The more time you add, the more likely it is for the option to actually move from out of the money to in the money. You can, of course, buy options that are already in the money and trade there, but those don't move as much. And they're considered safer, but obviously not as volatile as out of the money options, right? So if you're buying options out of the money, hoping for them to move into the money, you want a big movement in a short amount of time, because theta is, time decay, and an option becomes less valuable. So let's go back to the Tesla example, yeah? We have an option. We buy one option, strike price $650. Current Tesla price, 600, yes? This is a call option, right? Because we want it to go up. We want it to hit the strike price of 650. Currently at 600, we want it to move to 650. Okay, so Tesla has some good news. They have good earnings, more deliveries. They're releasing a new model. Explodes. Tesla explodes, all right? They go from 600 all the way up to 700. All right, so now the contract is in the money, right? Because it's a call contract. The strike price is 650 still, but now the option has increased in value because the share price is at 700. All right. So you could theoretically exercise this option, which means you could buy 100 shares of Tesla at 650 and then sell it immediately back to the market for 700. So let's do the math here. How much money would that be? So it's a $50 increase, 650 to 700, right? $50. $50 times 100, that would mean that you'd make $5,000. So that transaction is worth $5,000. To buy this option, you're gonna have to pay a premium or a fee to get this contract, which of course decays over time if it comes closer to expiration date. Again, we've talked about this theta decay. It's very unfortunate. If the stock doesn't move fast, theta decay will kill your premium price and make your contract less valuable. So let's talk about the other direction, right? You're investing in, let's say, GameStop. You think GameStop is going to go down over time because it's a failing business model. So you're going to buy puts, which is the opposite of a call. So let's actually go back to calls and puts. Calls, again, we said are when we want the stock to go up. It's a leveraged long. So how that works is that, again, we have 100 shares. It's leveraged 100 times. So instead of just buying one share, we're buying one contract for 100. So it's just leveraged 100 times. Versus a put is also leveraged 100 times, but it's a short. So it's a leveraged short, if that makes sense. All right, so let's say we're buying puts on GameStop. We're short on GameStop. So we're very bearish. So we buy puts, right? So if GameStop is currently at $190 roughly, then we could buy a put option, let's say for $100. So the strike would be $100. The premium would be pretty cheap because $100 is very far out of the money. For it to be in the money, the option would have to be above the strike price in this sense because it's a put, so it's the opposite, right? So if the stock becomes less valuable, the shorts obviously increase in value and it's leveraged because it's 100 shorts in one contract, right? And so then you make money, and if GameStop crashes very fast, there's a lot of hype and the volatility increases, and you can actually sell your option for a premium, even though it might not be worth that much. Like stocks, they increase in value and they might even be overvalued, which you could even sell them for more money. The premium could increase because it's a valuable contract and people want that contract, right? Because they believe it. So they'll pay more money than it's currently worth because they believe in the long term it's going to go up. All right, so let's talk about some common misunderstandings about options. So you can actually sell an option pretty much whenever, except if it's expired out of the money. If it expires out of the money, the option becomes worthless. So that means your initial investment goes to zero. Like if you buy an option for $100, it's worth nothing. But if it expires in the money, you could exercise it. I'm not really sure if you can sell an in-the-money option after expiration, but you can definitely exercise it. Before expiration, you can trade the premium, which obviously moves a lot depending on the movement of the stock. So I've actually never exercised an option personally, and I've only ever traded the premium. And so that is something that is very volatile and you can make a lot of money doing. Trading option premiums and not holding through expiration, trading far out expiration dates and trading those premiums for those options. I know that was a lot and I hope that explanation made sense. If not, I will definitely be making some more in-depth videos on this topic, maybe even dedicating one video to calls, one video to puts, and any other questions you may have, please leave them in the comment section below. This is Finance Fin. Make sure you like and subscribe to the channel. Be sure to check out some of my other videos, and I'll see you soon. Peace.